The IMF has projected that 7 African economies will have a growth rate of more than 8% this year, and 6 of the top 10 fastest growing economies in the world will come from the African continent. It's no wonder then that the African consumer market is regarded as the next investment frontier.
After Africa weathered the 2009 economic downturn and proved its resilience, executives and companies who had not yet established an African footprint started to seriously reconsider. In 2010, Africa had over 1 billion people living on the continent with a GDP of $600 billion US. And given the increasing population rate and workforce, GDP is set to be at an estimated $1 trillion US 8 years from now. By 2020, 17% of the world's population will live in Africa, and this puts the continent in the perfect position to start playing the numbers game. Although the continent has a low per capita income, the average income is growing, and even though there still may be political and economic instability in some African nations, the implementation of reforms has transformed the continent over the past few years. Investors are particularly interested in cashing in on the rising middle class of Kenya, Ethiopia, and Uganda in the east, Senegal, Ghana, and Nigeria in the west, and Angola, Zambia, and South Africa in the south. There's increasingly less reliance on traditional importing and exporting as a revenue stream, and more towards country domestic demands, which are greatly influenced by population size, declining poverty, and urbanization. Africa's consumer spending is predicted to hit $1.4 trillion US by 2020, and retail players want to cash in on this rapidly rising middle class.
Well, joining me in studio to discuss the rise of the African consumer, Martin Davis. He's the CEO of Frontier Advisory, Bill Russo, Director, McKinsey & Company, and David Cook, Director at Actis Africa Limited. Gentlemen, thanks very much for your time. Let's just start with the African consumer. It's obviously a hotspot, as we've seen illustrated over and over again. But in terms of income per capita, do you think we really are overcoming that challenge?
Well, of course, Bronwyn, it's very low, but Africa's 40% urbanized, and your presenter was alluding toward that. That's similar to India. The challenge is we've extremely fragmented market. I think the sort of major hurdle needs to be overcome in the next decade or so is to start to integrate markets. If we're looking, we talk about BRICS often. Goldman Sachs set the tone that big is beautiful. The more population you have, the more progressive supposedly you are as an economy. I think we need to start to put these economies together. The map you had up shows certain countries. We should be looking at certain regions instead. East Africa, for example, is probably the most progressive when it comes to region integration. We're no longer talking at small, fragmented African economies, but rather sort of regional, integrated economies, which are competing maybe not to the likes of the bigger BRICS, but maybe perhaps the Turkeys of this world, the Mexicos, perhaps maybe even Indonesias in terms of population size.
Perhaps that's a best case scenario. Are we ready to speak about the African continent as regions? I had this debate last week. You've got your East African community, obviously ECOWAS, Maghreb Union, and then you've got SADC. Is that how we're starting to look at the African continent in reality?
Yeah, sure. I think many are looking at it that way, creating natural groupings where you get larger pockets of population. Maybe even going back just to this segmentation of consumers and the rise of the African consumer. If you look back over the past decade, you've seen the GDP per cap on average for the individual African consumer rise 4.5% per year. Some of the hotspots you mentioned, like Ethiopia, are growing at rates of 9% per year. And if you project this going forward, we look at roughly 50% of households actually having disposable income by the year 2020. We define disposable income in excess of $5,000 US per year. The reason that's important is that you find at least 50% of the spending is on non-food items. And I think one other thing I think that's important underneath that is if you look at the individual segments, those that we call the globals are growing the fastest, and those are in excess of $20,000 per year. So this trend is absolutely happening. As Martin mentioned, it's really very much facilitated also by urbanization, where you see higher levels of productivity and much higher incomes.
Financials, telecommunications, retail. I would assume that those are some of the hotspots when trying to reach that consumer. Dave, the trends we're seeing on that front?
Very much so, Ron. And I think we saw the trend in telecommunication penetration really play out largely in the first part of the 90s and early 2000s. But that's a game that's now being played by the big multinationals. As a private equity investor, we're often now looking beyond that into sort of what are some of the telecom services and the crossover between financial services and telecoms in penetration of bank rates, the use of ATM credit cards, and which we're seeing fantastic growth in and we're investing specifically.
One of the trends is obviously the banking environment, and often when you go in country, you're presented with an overbanked situation from the local players, and yet there's still space perhaps for the international players. We've seen the consolidation in Nigeria and in that banking sector specifically. Do you think that we're going to see that trend set across the African continent?
Well, I think what we'll see is as we alluded to, is that the technology disrupting existing sort of business models, particularly in finance. We see it very much so in East Africa now, for example. I think, again, is we see consolidation in Nigeria, South Africa, saturation. I think from a financial services banking perspective, it's not so much bricks and mortar banking, it's more of a technology that'll enable banking for the, should we say, stereotypically, the base of a pyramid sort of consumer. But I think it's, it comes down to a leadership thing. Look at Nigeria. In three years, perhaps, the country's literally turned the corner. Still hasn't turned it fully, but turned a corner in terms of setting their tone around fixing up its banking sector, which ultimately is the foundation of development of any economy.
Let's go back to the retail space and the trends that we're seeing at the moment. A number of South African players trying to push ahead there. We've got the likes of ShopRite, obviously, trailblazing, and then other players, even Woolworths, with a foray into the African consumer. Are they doing it right? Do you think there's much more to learn in terms of trying to dominate this space from a retail perspective?
Look, I think from what we see, they certainly are picking the hotspots. Nigeria probably being the top. And I think you've got Woolies, Mr. Price, certainly ShopRite,
Massmart, obviously with their Walmart.
Is there. And I think they're actually quite selective. You see them opening, one or two stores in certain areas. I understand the store in Mozambique, as an example, is a big success for Massmart, but I think they're selectively testing the water. Interestingly, we just completed a very large-scale piece of consumer research, and one of the things that research told us was the demand for what we would call formal shopping. Of course, across the continent, you're probably still talking at rates of 90% informal shopping. And as a result, if you go into the Woolies or the ShopRite up in Nigeria, you see just absolutely incredible foot traffic. So there's an enormous amount of pent-up demand for formal retail.
90% you say informal though?
Informal, yeah. Outside of South Africa, of course. Yeah.
Can you add your thoughts to this trend that we're seeing?
Yeah, the rise of modern retail is here with us, but it is very early stage. I think it was in 2004 that Actis built the first modern international grade shopping mall in Lagos. Last year we opened the second one. That's how slow the progression has been. Quite patronizing, I think. Some in the outside of Africa thought, why do West Africans need shopping malls? Now you're seeing this huge demand for modern retail space by not only the South African retailers, but the international retailers as well, Inditex and the Zara Group and the like. But it is a slow game. So for the retail space, I think this is a 15-year game rather than a near-term play. Look how long ShopRite have taken to get financial returns out of their early stage exploration outside of South Africa.
I'm still going to push this space, because if we're looking at 90% informal in terms of your shopping trends, can the formal shopping environment ever hope? You say a long-term trend, 10, 15 years. You're not going to overcome that trend in the short term, are you?
Well, let me tell you the company I learned of actually this morning. It's called Tianshi. You may have never heard of it. It's a Chinese company. It's the Chinese equivalent of Amway. And it's opening across the entire continent. It's not formal. It's purely network-based. And it's selling Chinese pharmaceutical type equipment and products through to the bottom base of the pyramid, African consumers. And it's not formalized at all. But no one's heard of it yet. it's almost a very disruptive new sort of company or a new business model coming to the continent, again, to take advantage of sort of this rise, as you say, this rise of African consumer spending. However, just one thing to add, I think is very important. We often look at Africa increasingly, and this came, Bill, from your report in May 2010, just prior to the World Cup, the rise of African lions or African consumers. I think when one's looking at the continent through almost a salesman consumer perspective, it's fantastic. Profits to be made on the MTNs, the ShopRites, and all these we mentioned. But one must step back and look, retail investments are being driven by consumer capturing strategies. Perhaps from Actis' perspective, your investments are driven not by country, but by project. We need to start to see countries that are more innovative beyond merely offering consumers or projects, but countries that are more proactive in marketing themselves for capital, and ultimately into projects, into consumer space. Because I'm seeing investment in this country, in this continent, is not being driven by the country sale, but rather project and consumer capturing sale.
Maybe
Bill,
just a couple other comments on this. I think first of all, if you actually look at a global map of retail penetration, there's so much white space in Africa, and all of the big guys are looking at it. In this kind of global economy, everybody's looking for growth, I think is the first important thing. The second thing is retail in particular, I think, is actually quite good for local economies. I say that because it actually tends to be one of the largest job creators of any sector out there. So I think when you bring these two things together, you will see, albeit slow, progression on this path. By the way, I think the other large kind of inhibitor tends to be real estate. It's actually just getting
I was going to say, property is one of your biggest challenges.
Yeah, property in the right places.
What about cultural differences? Because again, we know that you can't paint the African continent with one brush, and we look at very different cultures, even within the East African community. Tanzania differs fundamentally to Kenya and Nairobi. Can you touch on that, Dave? Anything thinking on that front?
And this is, as an investor, this is something we experience right across the emerging markets. It amazes me, though, how you can have such different cultural nuances on the ground, and yet the issues that these businesses in the consumer space face as they're trying to grow are identical, whether it's Brazil, Nigeria, or India. Having said that, of course, having an understanding of those nuances on the ground is critical to make a successful investment of it. It's why we follow this local model where we have people from the regions operating in those regions. But ultimately, I think the cultural differences are, be aware of them, be sensitive to them. But it's not. It doesn't change the business models fundamentally to what we're seeing across most of our markets.
We're going to come back after the break, and I want to pick up on language barriers, because I think that could be a little more challenging. We're going for a quick commercial break. More on Investor Africa when we return. Don't go anywhere.